What if I told you your cash flow, not just your savings, could compound? We've all heard about the magic of compound interest, but most people think it only applies to bank accounts or watching numbers crawl slowly upward. The reality is far more powerful. What if your income could grow on autopilot month after month? Not by working harder, but by letting money do the heavy lifting. That's the secret most investors overlook, and it's the real story behind how compounding wealth works when you bring in the power of dividends. Take Daniel. Back in 2003, he invested $5,000 into a portfolio of dividend-paying stocks. He didn't try to time the market or jump ship when things got tough. Instead, he reinvested every dividend, every quarter, like clockwork. Each payout bought more shares. More shares meant more dividends. That cycle kept repeating. 20 years later, that initial $5,000 snowballed into nearly $60,000 and now throws off over $200 a month in passive income without him adding another dime. Meanwhile, his friend Ben took a different route. He invested the same amount but spent every dividend check he received. Today, his portfolio is worth just over $9,000. Same starting point, but a completely different result. That's the hidden truth. Compounding isn't just about portfolio growth, it's about growing your income stream. So, who are you in this story, Daniel or Ben? If that hits close to home, stick around. We're here to challenge money myths and show you how to create real freedom, not just numbers on a screen. Everyone talks about compound interest like it's some mythical force. But let's be real, most people picture a savings account crawling from $1,000 to $1,060 over years. Yawn. Here's what they're missing. Cash flow can compound too. When you reinvest income from assets like dividend stocks, you're not just growing your capital, you're building a bigger paycheck every year. Imagine owning a tiny vending machine that spits out cash every quarter. Instead of pocketing the coins, you use them to buy another machine. Then another. Do that for 10, 20, or 30 years, and suddenly you don't just have a machine, you've got an empire. That's how cash flow compounds. They say compound interest is the eighth wonder of the world, a phrase often echoed in financial circles with a kind of reverence. But here's the part that rarely gets talked about, where the real magic begins. It's not just in the slow, steady growth of savings accounts or the compounding of interest over decades. The real power of compounding comes alive when your dividends start generating more dividends. This isn't just theoretical. This is tangible income producing, automatic wealth generation. This is money working for you in a way that transcends the usual stock appreciation mindset. It's not just about watching numbers on a screen grow, it's about seeing real, spendable income show up in your account again and again, regardless of whether the market is rising, falling, or sitting still. This is the difference between a portfolio that looks good on paper and a portfolio that pays you to wait. And it's what separates those who talk about wealth from those who actually live off their assets. While the majority of investors chase short-term gains, hoping to flip their way to financial freedom, the smart ones quietly collect dividend checks. They reinvest them with discipline, and they watch their income stream compound like wildfire. Now, let's talk about the engine that powers all of this: time. If compounding is the vehicle that carries you toward wealth, time is the fuel that keeps that engine running. And when you combine time with consistent reinvestment, you begin to unlock one of the most powerful feedback loops in personal finance. Think of it like a snowball rolling down a hill. It starts small, barely noticeable. But as it rolls, it picks up more snow, gains more mass, more speed. Eventually, it becomes unstoppable. That's how reinvested dividends work. Every quarter, your investments spit out a payment. If you take that payment and reinvest it into more income-producing assets, you've just added another layer to the snowball. More shares, more income, more reinvestment, more momentum. Let's ground this in reality. Imagine you invest in a dividend-focused ETF like Vanguard Dividend Appreciation VIG or the SPDR S&P Dividend ETF SDY, both of which typically offer yields around 2 to 3%. At first, that return might feel underwhelming, especially compared to the hype of speculative assets promising 10x overnight gains. But the real magic of dividend investing isn't in instant gratification, it's in what happens over time. That modest 3% yield becomes a seed. Reinvest those dividends, and each payout buys you more shares. More shares mean more dividends. And that positive feedback loop strengthens every year you stay the course. In year 5, you might be earning $150 annually in dividends. Not life-changing. But by year 15, that number could easily grow to $1,500 or more without ever adding another dollar. And here's the kicker. That $1,500 is passive, recurring income. It hits your account no matter what's happening in the market. That's not just a nice bonus. That's the compounding engine in full effect. In fact, historical research shows that reinvested dividends account for more than 40% of the S&P 500's total returns over the last 9 decades. That's not an edge case, that's the rule. It means that if you're not reinvesting dividends, you're potentially leaving almost half of your long-term return on the table. You're not just missing growth, you're missing the heart of how wealth actually accumulates over time. Still not convinced? Let's look at the real-world difference this makes. Meet Daniel. Back in 2003, he invested $5,000 in a handful of dividend-paying stocks and committed to one simple rule: reinvest every dividend check. No exceptions. No temptations to cash out. Just steady, automated reinvestment. Over the next 20 years, Daniel never added another dollar. But because his dividends kept buying him more shares, and those shares kept producing more dividends, his portfolio didn't just grow, it multiplied. Today, that $5,000 investment is worth nearly $60,000, and it throws off over $200 a month in income. Again, without any additional contributions. Now compare that to Daniel's friend Ben. He also invested $5,000 in dividend stocks, but every time a dividend check came in, he spent it. Maybe it was coffee, groceries, little indulgences that felt harmless. But those small decisions added up. Without reinvestment, Ben's portfolio grew much more slowly. Today, his holdings are worth just over $9,000. The lesson: compounding isn't just about growth, it's about growing your income stream. Daniel chose to plant and replant his financial seeds. Ben chose to harvest early. And the results speak for themselves. But here's the thing, this isn't just about numbers. It's also about mindset. The reason most people never experience the full power of compounding has little to do with investment selection and everything to do with patience. They look at a $4 dividend payment and scoff. What's this going to do for me? They ask. And then they spend it. Or worse, they panic during a market dip, sell their shares, and hit the reset button on years of progress. Compounding hates interruptions. Every time you pull money out, stop reinvesting, or change direction, you're breaking the chain. What they don't realize is that $4 isn't the goal, it's the beginning. That tiny check is a signal. It's proof the system is working. If you're willing to stick with it, reinvest, and ignore the noise, those small checks will grow. 1 share turns into 5 into 15. And then one day you wake up and realize the machine is running on its own. There's also a psychological barrier to overcome. Here's something behavioral economists call hyperbolic discounting. It's our natural tendency to undervalue small future rewards in favor of instant gratification. We'd rather have $5 now than $10 later. But compounding punishes that mindset. It rewards the consistent, not the impulsive. And in today's world of social media hype, hot stock tips, and get-rich-quick promises, it's easy to forget that real wealth rarely comes with a bang. It comes in the form of boring consistency, quiet gains, steady momentum. The wealthy understand this better than anyone. In fact, some of the most financially successful families in history have built their fortunes not just through income but through reinvested income. Take the Rockefellers. Yes, they made their money in oil, but they preserved and multiplied it through trusts filled with dividend-paying stocks. Those trusts funded future generations not through speculation, but through reliable, repeatable cash flow. That's how compounding becomes generational. That's how you shift from being rich once to staying rich forever. And here's one of the most underappreciated tools for making this happen: DRIPs dividend reinvestment plans. A DRIP lets you automatically reinvest dividends into more shares of the same stock, often with no fees and even the ability to buy fractional shares. That means every penny of your dividend income is put back to work immediately, without you having to lift a finger. It's like having a fleet of tiny financial workers constantly multiplying while you focus on living your life. Let's say you own 100 shares of a stock that pays 50 cents per share each quarter. That's $50 every 3 months. If you pocket that money, it's gone. Spent. Done. But if you use a DRIP, that $50 instantly buys more shares. Over 10 years, without ever adding more capital, your 100 shares could become 150 or more. Now your $50 becomes $75, and the cycle continues. That's how small beginnings evolve into significant income. Still think your $2 or $5 or $10 dividend payment doesn't matter. Think again. The ultra-wealthy don't laugh at small checks. They deploy them. Because every reinvested dividend is a seed, and seeds, given time, become trees. This is how compounding really works. Not in grand gestures or viral financial hacks, but in tiny, consistent decisions made quietly over time. It's not just about numbers. It's about discipline, patience, a refusal to chase hype, a belief in systems over spikes. So the next time someone tells you compounding is boring, tell them they're thinking too small. This isn't just a strategy, it's a mindset. And it's available to anyone. Whether you're starting with $10 or $10,000, what matters most is that you start. Because in a noisy world, compounding offers something rare: quiet power. It grows while you live. It builds while you sleep. And it rewards the disciplined far more than the distracted. You don't need a finance degree. You need a plan, some patience, and belief in the process. Now you have the map. You understand how compounding really works and why most people never see it through. Wealth doesn't happen overnight. It's built bit by bit, choice by choice. This is not financial advice. It's an invitation to think differently, act consistently, and play the long game. Always do your research. Consult with professionals. Assess your risk tolerance. But whatever you do, don't sit still. Because time will pass either way. And the earlier you start planting seeds, the more trees you'll have when you're ready to harvest. And while stock prices can be volatile, dividends, especially from stable companies with long payout histories, tend to be far more reliable. Think Johnson & Johnson, Coca-Cola, or Procter & Gamble. These companies kept paying dividends through recessions, crises, even global events. So even if your portfolio dips temporarily, your income can keep flowing, and when reinvested, that's how the compounding engine keeps turning. But here's the catch: most people never give compounding enough time to work. And it's not because they didn't invest enough, it's because they didn't stick with it. Here's what usually happens. Someone starts investing, they get a few dollars in dividends, shrug it off, and spend it. Or worse, they panic when the market dips, sell everything, and hit reset. Compounding hates interruptions. Every time you stop reinvesting, pull out money, or shift strategy, you're breaking the chain. Another trap is the "it's not enough" mindset. Dividends look small at first, almost laughable. That's the camouflage. A single share becomes 5, then 15, then 50. That's when the magic becomes visible. But most people give up long before that. Why? Because our brains are wired for linear thinking. Behavioral finance experts call this the exponential gap. We just don't feel the power of small growth until it's already passed us by. On top of that, we're living in an age of constant distraction. Everyone's hyped up on crypto moonshots, flipping NFTs, or chasing six-figure overnight schemes. So when a 67-cent dividend hits your account, it feels like a joke. But that 67 cents isn't supposed to impress you now. Its job is to go to work, quietly, over time. And when you reinvest it, you're planting seeds for future cash flow. That's what most people don't understand. This is where DRIP's dividend reinvestment plans come in. They're one of the most overlooked tools in personal finance. A DRIP allows you to automatically reinvest your dividends into more shares, often with no fees. That means every payout buys more ownership instantly. And yes, even fractional shares. If your dividend is $1.22, it still reinvests. Say you own 100 shares of a stock paying 50 cents per share quarterly. That's $50 in dividends. Instead of spending it, your DRIP buys more shares. In 10 years, without lifting a finger, your 100 shares could become 150 or more, turning $50 into $75, then $100 per quarter. That's the dividend snowball in action. So why do people still ignore this strategy? Psychology. Small checks feel meaningless. Our brains want big, fast wins. That's why we discount small future rewards, a concept known as hyperbolic discounting. We want $5 now over $10 later, even though that logic sabotages our future. And with social media screaming about 10x gains and overnight riches, it's no wonder people overlook the small wins that actually work. Here's the irony. Most millionaires didn't get rich from lucky breaks. They built boring portfolios. They reinvested small checks. They stayed consistent. That's how compounding works, not with grand gestures, but with tiny, disciplined actions repeated over time. In the beginning, it feels slow. But if you can stay the course, something amazing happens. Your portfolio hits escape velocity. That's when it starts growing without you. You don't feel it in year 1. You live it in year 20. And the ultra-wealthy know this. Take the Rockefellers. They made their fortune in oil. Yes, but they preserved it through trusts packed with dividend-paying stocks. Instead of chasing flashy assets, they collected steady income, reinvested it, and used those dividends to fund trust funds for generations. That's how you stay rich. Dividend compounding builds income streams that don't require selling assets. No capital gains taxes. No market timing. No stress. In 2023, dividend-paying stocks even outperformed many hyped-up tech stocks. Why? Because smart money chases cash flow, not headlines. That's the real dream. Build a portfolio of strong dividend payers, reinvest those payouts, and one day, you can stop reinvesting and live entirely off the income. The best part? Dividends also provide tax advantages when structured properly, especially in trusts. It's how the wealthy pass on fortunes tax efficiently for generations. That's not just being rich, it's staying rich. Let's zoom out now. Compounding isn't just a math formula, it's a belief system, a mindset. It's about consistency, patience, and delayed gratification in a world obsessed with instant results. Wealth doesn't come from one big win. It comes from small, smart decisions stacked over time. Reinvesting, automating, staying the course. These are not just habits, they're identity shifts. You become the kind of person who builds, protects, and multiplies. And that's rare. From the outside, compounding looks boring. It's quiet. It doesn't trend. But it's the quiet ones that build empires while everyone else is chasing noise. As James Clear said in Atomic Habits, you do not rise to the level of your goals. You fall to the level of your systems. And compounding, it is the system. So if you're ready for financial freedom, stop chasing spikes. Start stacking systems. This is how compounding really works and why most people miss it. Wealth is behavioral. It's built in small, invisible moments, clicking reinvest, ignoring market noise, skipping the hype trades, and trusting the process. Most people overestimate what they can achieve in a week and underestimate what they can build in a decade. But not you. If you've made it this far, you've already proven you're not most people. So here's the challenge. What's one habit you can start today to activate your own compounding machine? Drop it in the comments. We want to hear from you. Because this journey isn't just about numbers, it's about reclaiming control. Building freedom slowly, deliberately, and unapologetically. Whether you're starting with $10 or $10,000, what matters most is that you start. Not tomorrow. Not when the market is better. Not when you feel perfectly ready. Because the truth is, you'll never feel 100% ready and the market will never be perfectly timed. But time is always ticking. And every day you wait is a day you lose the most valuable asset you'll ever have, time for your money to grow. In a world that screams for attention, where everyone is chasing the next big thing, compounding offers something different, something rare. Quiet power. It doesn't flash. It doesn't trend. It doesn't give you a dopamine hit like a viral stock tip or a crypto pump. But it works. It grows while you live. It builds while you sleep. It compounds when you're busy, distracted, or even resting. It's not magic, it's math, multiplied by behavior. And it rewards the disciplined far more than the distracted. You don't need a finance degree. You don't need a Wall Street connection. You don't need to be perfect. What you need is a plan. A small, simple habit you can repeat consistently. A commitment to keep going, especially when it feels like nothing's happening. Because trust me, something is happening. Below the surface, the seeds you plant today are taking root. They just need time and your belief to grow into something extraordinary. Now you have the map. You understand how compounding really works. Not just in charts or calculators, but in real life. You see why most people never benefit from it, because they quit too soon. They chase fast, flashy wins instead of planting long-term wealth. But you're different. If you've come this far, you've already proven that. You're building something the world can't see yet, but one day, it will. Wealth doesn't happen overnight. It doesn't come in windfalls or lottery tickets. It's built bit by bit, choice by choice. It's built in those small, consistent actions. Clicking reinvest, ignoring the panic, staying the course. And one day, when everyone else is asking how you did it, you'll smile because you'll know it wasn't luck. It was compounding. It was patience. It was you. And just a quick reminder, this video is for educational purposes only. It's not financial advice. Always do your own research and consult with licensed professionals before making investment decisions. The markets will fluctuate. Past performance doesn't guarantee future results. But your behavior, that's the variable you control. That's your edge. So if this message resonated with you, if it stirred something in you, made you think differently about your money, your future, your freedom, then do us a favor. Give this video a like. Share it with a friend who needs to hear this. Subscribe to the channel because we're just getting started. There's a whole world of wealth building waiting for you, and we'll be right here, walking with you every step of the way. Because no matter where you're starting from, the journey to financial freedom begins with one simple, powerful decision. Start now and never stop. See you in the next one.